All right, let's jump right in. Today, we're talking about something huge, monetary policy. You hear about it all the time, right? The Fed is raising rates, the Fed is cutting rates. But what's actually supposed to happen when they pull those levers? And more importantly, does it really work the way the textbooks say it does? Okay, let's get into it. So this is really the core question for us today. You got the clean, simple theory on one side, and then you have the real world, which, as you can probably guess, is a whole lot messier. We're going to see how that beautiful plan holds up when it meets reality. So first, let's lay out the blueprint. What is the grand plan here? What are central banks like the U.S. Federal Reserve actually trying to accomplish? Well, it all starts with something called the dual mandate. And here it is, the heart of the matter. Congress has given the Fed two main jobs, two primary goals. First, make sure as many people who want a job can get one. That's maximum employment. And second, keep prices stable, which to the Fed means keeping inflation humming along at around 2%. It is a constant, delicate balancing act between those two things. A really great way to think about this is like a thermostat for the entire economy. If things get too hot, if inflation starts running wild, they crank the temperature down. But if the economy gets too cold and unemployment starts to creep up, they turn the heat back up. Sounds simple enough, right? So how does this economic thermostat actually do its job? Well, in theory, it's a pretty neat and tidy machine. There's a clear, step-by-step chain of events that's supposed to unfold. Let's walk through it. Okay, so here's the classic textbook version. Step 1. The Fed tweaks its main interest rate. That's the rate banks charge each other for overnight loans. Step 2. That change is supposed to ripple out almost immediately to the rest of us, affecting the interest rates on our car loans, our mortgages, our business loans. Step 3. That makes borrowing money either cheaper or more expensive, which naturally influences how much we spend on the big stuff. And that leads to Step 4. This shift in spending either revs up or slows down the entire economy's demand for goods and services. And finally, Step 5. The economy gets nudged back to that perfect sweet spot, stable prices and lots of jobs. It's really a beautiful concept when you think about it. It's this simple, elegant machine. You adjust one lever and this massive, complex economic engine is supposed to respond in a totally predictable way. But does it really? Because this right here is where our neat and tidy story gets a huge reality check. It turns out that smooth-running machine, well, it often sputters, and sometimes it seems to have a mind of its own. This quote from a recent economic study just nails the problem. Heterogeneities. It's just a fancy academic word for differences or variety. What it's saying is that the channels monetary policy travels through aren't one single uniform pipe. Oh no. It's more like a really old, complicated plumbing system with a wild mix of pipes, some wide, some narrow, some leaky, some clogged. So let's go back to our thermostat analogy for a second. The Fed isn't controlling the temperature in one single cozy room. No, it's trying to manage a massive, sprawling office building. And in that building, turning down the thermostat might make the basement absolutely freezing, while the corner office on the top floor barely even notices a change. That's the reality. So now, let's pop the hood and see what that research actually found. What are these real-world frictions that mess with the machine? Let's take a look at the evidence. Okay, the first big one is the banking industry itself. It's not the same everywhere. It turns out that how much competition exists between the banks in your specific town or city can totally change how a Fed rate hike or cut actually lands for you and for local businesses. Now, these graphs might look a little complicated, but the story they tell is absolutely fascinating. Let's break it down. On the left, we're looking at what happens after a positive shock. That's just economists speak for a rate hike. In places with less bank competition, that's the gray area, you can see that the higher rates get passed on to customers much, much slower. Now look at the graph on the right. This is a negative shock when the Fed cuts rates. And here's the crazy part. Those same uncompetitive markets are actually faster to pass on the rate cuts. It's a totally lopsided effect. It means the Fed's actions don't land evenly everywhere. The impact really depends on your local banking scene. All right, on to our second big friction. And this one isn't just about the banks, it's about the businesses themselves. Specifically, where a company gets its funding from makes a huge difference in how it reacts to what the Fed is doing. And this creates a really clear divide. On one side, you've got companies that rely almost entirely on old-fashioned bank loans. When the Fed hikes rates, these guys feel it directly, and they feel it fast. But on the other side, you have companies that can issue their own bonds to raise money. For them, it's like having a shield. They can kind of bypass the banking system, which makes them way less vulnerable to those traditional policy changes. And these graphs show us exactly what that looks like in the data. On the left, after a conventional rate hike, you see a big drop in investment for the firms that depend on bank loans. But now look to the right. These are the firms that can issue bonds. They can weather that storm much better because they have another tap for cash. Their investment dips, sure, but it's way less severe. This is just powerful proof that the Fed's main lever doesn't hit every business in the same way, not even close.
Okay, so we've seen the simple theory and we've peeked into the messy reality. What's the big takeaway here? Why does all this granular academic detail actually matter for the people making the decisions, and frankly, for the rest of us?
So what does this all boil down to? Well, for one, that simple textbook model is really just the first chapter of a much longer, more complicated book. The real economy is just full of these frictions, things like bank competition and corporate financing, that completely change how monetary policy actually plays out. It means the impact is uneven and sometimes really hard to predict. For the people in charge of that economic thermostat, it means they can't just flick a switch. They have to understand the complex, messy plumbing of the entire building. And all of this leaves us with a really important final question. Our economy is constantly evolving. New ways to borrow, new financial markets, new technologies. So as the building itself gets more and more complex, how do the tools we use to manage it need to change too? That's the billion-dollar question, and it's the central challenge for economic policy now and into the future.